Options are financial derivatives that are extremely volatile. As the price of a stock moves slightly, you might see wild swings in the price of your options on that stock. But sometimes you might have made the right prediction on the stock, yet witness your option lose value regardless. There are two main reasons your prediction could be right, but your options are nonetheless worth less than what you had originally paid for them. The first reason is called Vega. The second reason is called Theta. Vega is a major source of loss for option traders who trade the news, especially. In my earnings tradings group, Exposing Earnings, sign up today. We trade exclusively earnings reports, and this means we take option positions before a company reports its quarterly earnings, selling those options after earnings, assuming we take long option positions. Here is an example. Recently, we wanted to short pins into earnings. I bought pins puts a day before the earnings report was released. Pins reported earnings and saw a drop in monthly active users, as I had predicted. The stock then fell 20%. My options tripled in value from the movement. However, it does not always work out so perfectly. Some earnings traders might make the right prediction, buy an option, and still lose money from the play. The reason is Vega loss. Vega represents the change in the option value per change in volatility. When new information is made public, such as through earnings reports, volatility drops. Correspondingly, option prices drop, which is why merely predicting the direction of a movement is not enough to earn you profits if that movement was the result of some news. To mitigate Vega risk, here is a rule of thumb. Go with near-term options if you know some important news is going to be released soon. Long-term options have higher Vega values and will be punished to a greater extent on news releases. Combined with the rules of thumb for Theta, which we will discuss next, you'll see that the best options for trading earnings are generally near-term in-the-money options. Theta is the other big killer of long options traders and represents time decay. Assuming the stock does not move in price, the Theta value shows how much you can expect to lose in that option per day. Thus, to not lose any money in your option, you need the stock to rise at least the minimum Theta value. In other words, whatever your Theta value for that option is, translate that into dollars, you need to see that movement per day or else you're losing over time. For example, here is the Theta value for a SPY August 20, 4:30 call. The Theta of negative 0.137 means that over the next 24 hours, this call will lose you roughly $13.7 in value if the SPY goes nowhere. In other words, for this call to not lose money, we'd need the SPY to move up at least 20 cents per share over the next 24 hours. Because Theta increases with time, as the expiration date approaches, you will need to see even more movement in the stock to break even. Theta is larger too, with options at or near the money. Here are some rules of thumb to help you mitigate your options time decay. Avoid near-term at-the-money options. Avoid long-term in-the-money or out-of-the-money options. That is, if you want to play near-dated options, go with in-the-money options. And if you want to play far-dated options, only then go with at-the-money options. In this way, you will avoid the periods in which Theta decays the quickest. If you are trading options for income, you need to know what affects option prices. Without understanding Vega and Theta's effects on option value, you could find yourself in a position where you made the right prediction on the stock, but your options lost value nonetheless. Want to know how to trade options for reliable income? Sign up for my stock chart reading course at damonvario.com.